Last night, while you were asleep, your bank made money off you. Not because you did anything smart, not because you invested, because you did absolutely nothing. And in the banking industry, your nothing is their everything. Here's the scene. It's 3 a.m. You're horizontal, possibly drooling, definitely not thinking about your checking account. Meanwhile, in a server room somewhere in Delaware, and it's always Delaware, by the way, because Delaware has some of the most bank-friendly corporate laws in the country and more Fortune 500 companies registered there than almost anywhere else. Delaware didn't become the corporate capital of America by accident. It got there by making it very easy to be a corporation and very inconvenient to be a regular person. So in that server room, an automated system is quietly running through your account like a raccoon through an unlocked trash can, calculating, reordering, assessing, and depending on what you spent yesterday and in what order, it may have just charged you $35 for being $8 short on a Tuesday, not $80 short, not $800, $8. The price of a Chipotle bowl, and your bank charged you $35 for it, which is technically a 437% fee on a burrito budget gap, the kind of number that would get a payday lender dragged in front of Congress. But your bank calls it a service charge and buries it in size 6 font on page 31 of a document nobody has ever read all the way through without falling asleep first. Now here is where the story starts to get interesting. American banks collected $23.2 billion in overdraft fees last year. $23 billion for the privilege of briefly not having enough money. That is more than the entire GDP of Iceland, a country with geysers, universal health care, and a financial crisis so bad its citizens showed up to Parliament banging pots and pans until the government actually resigned. Your bank, meanwhile, has a mobile app that logs you out every 90 seconds, and a customer service line where you wait 45 minutes to speak to someone named Kevin, who cannot help you, but will absolutely ask you to rate the experience afterward. And the best part, the part that should genuinely make you pause, is that this $23 billion didn't come from wealthy people. Wealthy people don't overdraft. It came from normal, employed, mostly fine people who checked their balance, saw a number that looked okay, and went to sleep. People exactly like the man you are about to meet. Real quick before we continue. Nobody sent me, nobody reviewed this script, nobody is paying me to make any of this sound more reasonable than it actually is, which is useful. Because once you start reading fee schedules, annual reports, and terms and conditions, reasonable becomes a surprisingly flexible word. This channel is called Unseen Finance, and the entire reason it exists is because the most important financial stories are almost never where people are looking. They're not usually in the commercials. They're not in the slogans. They're definitely not in the smiling stock photos of two people discussing their financial future over a salad. They're usually buried somewhere less convenient. A disclosure, a footnote, a fee schedule, a document you agreed to while trying to get back to your actual life. That's what we do here. We find the story hiding underneath the story. Subscribe, not because every YouTuber says that. Subscribe because the people who ignore the fine print eventually end up paying for it. And because around here, we have a simple rule. The story is never where they tell you to look. Now, let's meet Derrick. His name is Derrick Osei. He is 32 years old. He lives in Atlanta, Georgia, and he makes $71,000 a year as a supply chain analyst, which sounds solid until you realize Atlanta's cost of living has been creeping upward with the quiet aggression of a landlord who just discovered real estate apps. Derrick drives a 2022 Nissan Altima that he leases for $412 a month because his cousin told him leasing was smarter than buying. And Derrick has not yet had the honest conversation with himself about whether his cousin was right or just confidently wrong, which, as we are about to see, is a very expensive distinction. He has a Wells Fargo checking account, a savings account with $410 in it that he calls his emergency fund, 4 Uber Eats orders a week, a $165 a month gym membership he has not used since March, and he still Venmos his college roommate's Netflix password, even though that roommate now makes more money than Derrick and has never once offered to split it. Derrick is not broke. He is not reckless. He is exactly the kind of person every major bank in America prays they get to keep as a customer. Employed enough to keep depositing, busy enough to stop checking, and just financially stretched enough to make one small mistake a month that costs $35, which, across 12 months, is $420 a year, which, again, is not an accident. There is one thing about Derrick that will matter more than anything else in this story. Derrick does not read his bank statements. He checks his balance. He looks at the number looks okay, and he moves on with his life. There is a difference between those two things, so important that it is the entire reason this video exists. And it is the reason banks spend millions of dollars making sure the difference never gets explained to you. So let's explain it. It is 3 a.m. on a Thursday, and Derrick is asleep. His phone is on the nightstand, his Wells Fargo app is closed, and in that server room in Delaware, the automated daily settlement sweep has just begun. This sweep is not a secret. It is not illegal. It is disclosed. And I use that word with tremendous generosity. On page 14 of the 52 pages of terms and conditions Derrick agreed to in 2021 while he was waiting for his Chipotle order, he clicked accept. The cashier handed him his bag, and somewhere in that exchange, Derrick unknowingly signed off on something that would quietly take money from him for years. Here is what the sweep actually does. It takes every transaction from the previous day, rearranges them in a specific order, and runs them against his balance one by one. The order is not random. The order is designed. And the design, as you are about to see, is not designed for Derrick. On Wednesday, Derrick bought a $5 coffee, a $13 lunch, and $42 of gas, $60 total. He had $210 in his account. He had $150 left. Everything is fine, except at 3 a.m., his $165 gym membership, the gym he has not visited since March, and which is currently thriving on Derrick's loyalty, hits the account during the sweep. Still okay though, right? 210 minus 165 is $45. He's fine, except the bank doesn't process the transactions in the order they happened. The bank processes the largest charge first. That's been proven in federal court, documented in settlement filings, and admitted by multiple institutions. So, the $165 posts first. Derrick now has $45. Then, the $42 gas purchase posts. Derrick now has $3. Then the $13 lunch hits a $3 balance. Derrick is now negative $10. Overdraft fee, $35. Then the $5 coffee posts. Second overdraft fee, another $35. Derrick spent $60 he had, and $10? He didn't. His bank charged him $70 for the $10 he didn't have. That is a 700% fee on a $10 shortfall. Now, here is the part that should stop you. Chase paid $75 million in settlements over overdraft practices. Bank of America paid $410 million. Wells Fargo paid $203 million. Nearly $700 million across 3 banks. And after the settlements, every one of them issued some variation of the phrase, "We remain committed to our customers." Then, the fees kept rolling in. Because when a company pays hundreds of millions to settle a practice, and continues doing versions of that practice afterward, the math is telling you something. The fine was a cost. The revenue was the reason. So Derrick wakes up, sees the overdraft fees, and calls customer service. He spends 38 minutes on hold. A representative refunds one fee because it is his first complaint of the year. Derrick feels like he won. He tells his friend at lunch. His friend is impressed. And on the drive home, Derrick makes what feels like the responsible adult decision. He signs up for overdraft protection. His bank will now automatically transfer money from savings whenever his checking account runs short, for only $12.50 per transfer. And Derrick is right. That is better than $35. The problem is that better and good are not the same thing. Over the next 6 months, Derrick triggers 9 transfers. That's $112.50 in fees, pulled directly from his $410 emergency fund, which is now $297.50, which is not an emergency fund. That is a broken car window away from becoming a crisis. And here is the number they do not want you to calculate. Customers enrolled in overdraft protection pay dramatically more in fees than customers who simply opt out and let transactions decline. The bank sells overdraft protection as a safety net. The data suggests it functions more like a subscription to the same problem with a slightly different price tag. But fees are not where the real money is. Fees are the appetizer. The main course is what happens the moment Derrick's paycheck arrives. The moment Derrick's paycheck lands, $2,958. Every other Friday, direct deposit, reliable as sunrise. Wells Fargo starts making money with it. Not some of it. All of it is available to support lending activity because in 2020, the Federal Reserve reduced reserve requirements to 0. The vault in the logo is branding. The money is working somewhere else almost immediately. Derrick earns 0.01% on his checking account. His bank can lend money at rates that range from single digits to well over 20% depending on the product. They pay him a fraction. They keep the spread. Every single Friday. While Derrick is at work, and here is the number that makes this real, in 2023, Wells Fargo reported $52.4 billion in interest income. The amount paid back to depositors was a fraction of that. The gap between those numbers represents one of the most profitable businesses ever created. Borrowing money cheaply, lending it expensively, and collecting the difference. On Derrick's average balance of roughly $2,800, the bank earns far more from his money than he earns from keeping it there. Derrick doesn't notice because the amount he receives is measured in cents, and cents are easy to ignore. That is the entire game. Not stealing enough to trigger outrage, just collecting amounts small enough that nobody pays attention. Cent by cent, fee by fee, transfer by transfer, across millions of people who assume the number on the screen means their money is working for them. Okay. Here is what Derrick does now. And the good news is that none of it requires a finance degree, a stock-picking course, or a cousin with strong opinions. First, Derrick moves his savings into a high-yield savings account. Not Wells Fargo, not Chase, a high-yield, FDIC-insured online account. On his $410 emergency fund, the difference isn't life-changing. But that's not the point. The point is that once his emergency fund grows to where it should be around 3 months of expenses, the gap becomes hundreds of dollars per year. Money earned for doing absolutely nothing except putting the cash in the right place. Second, Derrick opts out of overdraft coverage. He is legally allowed to do this. If the money isn't there, the card declines. The barista looks at him. He looks at the barista. Life continues. A declined transaction lasts 4 seconds. An overdraft fee lasts until the charge clears. Derrick spent years paying real money to avoid a moment of mild embarrassment. Third, and this one requires honesty, Derrick cancels the gym. The gym he has not visited since March. He is paying $165 a month to maintain the idea of himself as someone who works out. That idea costs $1,980 a year. And over time, that becomes tens of thousands of dollars that could have gone somewhere else. The gym is not improving Derrick's health. At this point, it is improving the gym's revenue. If Derrick does all 3 of these things, he recaptures thousands of dollars in the first year. Not from a raise. Not from a side hustle. Not from some secret investing strategy. From stopping leaks he didn't know were open. And if he doesn't, if he keeps doing what he's been doing, then by middle age, tens of thousands of dollars will have quietly drifted out of his life. Not because of one catastrophic mistake, because of hundreds of tiny ones. The kind nobody notices until they add them up. The masked man in the suit doesn't rob you. He doesn't need to. He wrote the terms and conditions, built the app, named the fee a service charge, put the vault in the logo, and waited for you to click accept while your food got cold. He is not a movie villain. He is a businessman who figured out a long time ago that your inattention is worth more than your trust. If this video just cost your bank money, and it probably did, subscribe, not for me, for the next video. Because the next one is about what your credit card company does with your minimum payment every month, and the numbers involved make overdraft fees look small. Subscribing is free. There are no fees. No reordering. No Kevin. And unlike your bank, I will not charge you $35 for forgetting to show up. The system is not broken. It is working exactly the way it was designed to work. The only question left is whether you're still asleep.